What is the market telling me this week? Welcome to the Rutherford Report, and I'm your host, The Angry Investor. Now, Wall Street makes me angry because it always tries to mislead investors, and I'm here to cut through the BS and share with you what really matters. So hit that like button, subscribe to this channel, share this with someone who would get a lot out of it, leave me a comment. Anything you can do to get the word out, I really appreciate it. This is the place to be for the financial news that matters for your net worth. Let's get to it. So one of the most interesting things that everyone likes to watch is the presidential election. But there's a really funny thing about that. You got to ask yourself, does it really matter? So let's look at the data. And here I am over at realinvestmentadvice.com. And they've been nice enough to organize a bunch of data for us. So if you look at this handy dandy graph, you can see that here's the S&P 500 and a bunch of really close presidential elections in the past. And you can see that no matter whether it's a Republican or a Democrat, the market's going to do what the market's going to do. And it seems to typically follow this pattern where before the election day, the market goes down, and then after the election, it goes up. And it really doesn't matter if it's a Republican or a Democrat. The market just does this. And this is because the market hates uncertainty. And once the election has happened and it's over, well, the uncertainty has passed, and it's time for the market to keep making money. So I want to go through a few more important things. If you look at this seasonal adjustment here, this is all of the data going back to 1928. We're a little past this line now. And typically, you can see that at the very end of the year, the market goes up. So everyone out there thinking, does the presidential winner matter? Well, maybe it matters, maybe it doesn't. But historically, it doesn't. So my bet on that is that there are all these people running all these businesses, and they're incentivized to keep making money and keep making their business bigger and better so that they can sell stock, get stock options, sell more stock, and make more money. And that, I think, is really the driving force. If you look at Charlie Munger's quote about incentives, incentives matter, and that's what the incentive is, for the market to go up and to make more money. Of course, it could go up, it could go down in the medium term, but over the long run, it's going to go up as long as the economy continues to expand. And if the U.S. economy isn't expanding, well, another economy will expand. And you can take your money and invest there. You just have to watch and know what the trends are. So I want to go scroll down really here and look at just one last piece of data, because when Wall Street is telling you that the presidents matter, well, they're trying to lead you to an emotional place. At least that's what I believe. Because if you look at the average annual performance cited right here from 1933 all the way up to 2022, you can see all these stats. And if we've got a Republican president, which we do, and here we have a Republican Congress, the average is 12.9% a year. There you have it. There's the average. I always like to look at the data because the data keeps me centered. It doesn't allow me to be taken advantage of by Wall Street. One of the other things everyone is so worried about, they're all worried about the yield curve. Because historically, almost every single time, if not every single time, I have to look specifically, but I think there was one time that it didn't quite do it, but almost every time that the yield curve inverts, well, we end up having a recession. And that means the price of money is more expensive to borrow it sooner, and to borrow it and pay it back later, it is less. And typically you would think it would be the inverse, because if you're going to loan me $100 right now, well, if I pay you back tomorrow, it might be less risky than if I pay you back 30 years from now. When there's a recession, this typically inverts because people get more concerned about getting paid back sooner, which is the exact opposite of normal. So you can see that historically we have inverted yield curves and then we have a recession. But hold on a minute, because everyone out there who is looking at this data, I think they're a little confused. They're just not looking at the data, or they're really kind of amateurish in their data reading. So I'm going to take a prediction here, and I'm going to walk through a few things that I'm noticing that I don't think most people are noticing. So here we're looking at the 30-year fixed mortgage rate average. Let's just call that the price of money. this is how much it costs for money, because everyone in the economy needs to borrow to buy a house. Now, there's a real interesting thing here. If you look at the 30-year mortgage rate and you look at the 30-year treasury rate graphed on the same graph here, you can see way back here in 2015, 16, 17, there's about a 1-point spread. So it's really easy to see on the graph here. And 2015, you can see that the red line was at 3 and the blue line was at 4. The blue line representing the mortgage rate and the red line representing the treasury rate. Now, you can see that most of the time they stick kind of close together. And if I really zoom out this graph all the way, you can see for the most part, they're pretty much about give or take 1% apart. You can just kind of visualize it. Of course, now there are a few times that it bumps a little bit apart, but something very interesting, and let's just walk through this as a thought experiment, because I think this is an important signal, because everyone's been saying, oh, there's a recession, and they've been wrong. So why could they be wrong? Is it perhaps that they aren't reading the data correctly? So if I look at the last 10 years here, you can see that the mortgage rate is typically about 1% higher than the treasury rate. But something weird happens here in the second half of 2022. Exactly when it starts, I don't really care. Just around this area we're talking about, just eyeballing it here. And you can see from this graph that the spread has now moved from just 1% to closer to 2%. Here you have the red line is around 4.5, and the mortgage rate here is much higher. It's a little hard for me to get it exactly when this graph is not cooperating, but you can see that it's really closer to 6.75. So that's an added 1.2%, give or take just a little bit. We don't need to be precise here. All I'm doing is I'm looking at, hey, typically everyone says the yield curve is a big problem and it inverts. Well, the price of money has changed if I'm looking at this. Something weird is going on since 2022, and I don't know what it is. I don't need to know what it is. And guess what? That's exactly in this area here. The second half of 22 is when this starts to invert. The time frame is very close. You know what? Let's look at the price of money. So here is the 3, and then we'll get to it, and you'll kind of understand what I'm saying, hopefully. So here we have the 3-month treasury. It's at 4.5, and the 30-year is at 4.6. Well, if I insert that extra percentage point that usually is there, that's not there, give or take, that would say that the treasury market is not inverted. And the 3-month would be at 4.5. And then if this weird discrepancy wasn't there, well, maybe we'd be at 5.6. So I have to ask myself, what's going on with the long end, and is it really inverted? And if it's not inverted, well, then we're not about to have a recession. Now, could we have a recession tomorrow? Yes, but I'm looking at the data right here and right now, and there's some sort of weird discrepancy in the price of money that isn't normally ever there. It's been going on for a while. You got to ask yourself, why is this happening? Is it because they don't want to pay such a high interest? I don't know. But what I can do is look at the market, and the market is going up. Here's the S&P 500. It's gone up all year. It's continuing to go up. It's hitting new all-time highs. And if we look at the leader in the market, the AI revolution, because I always like to look at the market, and the market is telling me there's no problem, because here's the market leader, NVIDIA. It's going up. It's hit new all-time highs. Yeah, sure, it's pulled back a little bit, but its trend is intact. So I have to ask myself, are we climbing a wall of worry? Because the data is looking really good. Everything's looking strong. So until the data starts to look bad and the market is downtrending, I'm not really worried about this so-called recession. And as everyone else is very worried about it, well, they're going to be providing me with tremendous opportunities to invest. If you want to know what I'm investing in right now, you can go to highreturnlowrisk.com and I'll share it with you. Until then, hit that like button, subscribe to this channel, share this with someone who would get a lot out of it, and we'll just keep watching the market to see what happens. How am I using this information to protect and grow my wealth? Go to highreturnlowrisk.com.